From Informa, in financial intelligence business, and EPFR is the fund flows brand of that business. We provide fund flows and allocations for both sell side and buy side on a daily, weekly, monthly frequency. And today's talk will be about that and the usage of it in a quantitative way. So my background, I do have a PhD in quantitative finance. I literally used EPFR data in my PhD thesis, which became a job. And back before Informa, I was working as a multi-asset quant portfolio manager for HSBC, Global Asset Management. I've worked for more than 4 years in that, and moved to this job just a year ago. Flow data, fund flow data is generally known as its informative capability. Knowing about flows matters, especially you can see EPFR cited in the most of the financial community, Financial Times, Bloomberg, Reuters. They all generally cite EPFR, and they talk about fund flows to a specific asset class or a specific country, and it's good. It has always been good to know. This EPFR was founded in 1995 by Ian Wilson, and he was in Cambridge, US, and it was just a hobby at first. He started generating these monthly reports of fund flows to emerging market funds. And then this became a real business going forward. And yes, it is quite informative in general, talking about fund flows, and you can see why here. So this is global equity index, MSCI All Country World Index versus the global equity flows. You can see the correlation between those two, and looking at this. Typical quant person might get excited of, there might be some kind of explanatory relationship between these two, unless the latest outflows from equity funds versus the MSCI holding still, at least, it is historical high levels. But so this, visual inspection of this chart actually. Works quite well when we look at in the same time fund flows versus returns, the global equity equity returns. So in the chart you can see the MSCI All Country World Index returns versus flows at the same time at T+0, which means that in the same day. So, and yes, there's a relationship. And I'll just show you some numbers as well. But this is quite statistically significant relationship between flows. But when we go to T+2, so when you use flows to know about the equity returns at T+2, which means a forecast, and this is actually generally our leg of data. So we know flows at a daily frequency generally at T+2, and this is basically that you can't see any information. So this is the end of my talk. Thanks for coming. Yeah. Yeah. So, and more interestingly, if you look at this across different asset classes, again, so at T+0, the T stats, it shows the significance of these coefficients. They're all positive. They are significant, showing the relationship between the fund flows and returns, but it's just at T+0. When we go to T+2, we don't see that relationship. That all dies out. And also for Japan, UK, and US, we see even a negative relationship between those two, and kind of significant. But this isn't what we expect. So this is kind of a contrarian mean reversion finding, which isn't expected because you expect fund flows to generally forecast the equity returns, right, in general. So this is this is exactly actually what are, what quants generally working on our data look in general and try to understand. And we generally say you might not find something quite significant when you look at this time series historical information at the daily frequency. So, EPFR data has been cited more than 35 different papers in the literature, and all of them are from good academicians. And the content of their talks are all about, they're talking good about fund flow data. They're talking about information coming up from fund flow data. So what's happening there? So to do this, I'll just give you some couple of examples. So this is a recent one from two analysts from Bank of England, Gino and Alaf. They have been working on this, the effects of unconventional monetary policy. Actually, if I do this, I think it will be much better. Yeah, perfect. So the effects of unconventional monetary policy and the portfolio choice of international mutual funds. When they look at EPFR data, they use EPFR data. They simply find that the large-scale asset purchases made by big central banks has affected the mutual funds holdings and their ratings across U.S. Developed markets, developed market ex-U.S. and in EM. So main finding, they find that this large-scale asset purchases has actually generated a shift towards U.S. equities and has generated a kind of outflow from other developed markets and also emerging markets. That it has generated an inflow to emerging markets as well. So this kind of generated a hinted and a finding, especially for equities, that there's a shift, a balance, a change in balance is occurring within different geographies, within different asset classes. Another example coming from ECB. Again, very similar finding. They again look at QEs and their effects and fund flows and being affected some kind of policy information, and literally they find that again this generates an inflow towards emerging market equities versus an outflow from US markets. And lastly, this is from BIS. They look at the reallocations of the US fund investors in general. Yes, they run the same test that I showed you, time series regressions between asset classes, and they conclude that they again doesn't find a significant relationship. But what they find is quite important, especially around the FOMC weeks. They find the institutional investors tend to reallocate towards equities, bonds, if there's from bonds to equities actually, if there's a significant move coming from these central banks. So the main message coming from these three simple papers is it's not about time series relationships, flows predicting T+1, T+2 equity returns. It's actually the cross-sectional information coming from fund flows. That is kind of important. So this is another example. And when we look at the correlations between asset class returns and fund flows, and the correlations within fund flows itself, again we find the same thing. But when we look at the cross-sectional information, we run a very simple backtest, we find that the flow momentum variable quite significant. So the flow momentum is a very simple idea of ranking stocks or ranking countries or ranking assets towards their flows in the cross-section and then going long in the ones that had received inflows and going short in the ones that had received outflows. So instead of looking the time series information, each week, each day, each month, the exercise is to select the asset classes or countries that had received outflows or inflows and going long and short according to that information. So this is, I'll get into more detail on this, but before doing that, I just want to give a little bit more information about EPFR and our database, then I'll show you our detailed examples. So as I said, EPFR has been found in 1995. We provide daily, weekly, monthly fund flow information, plus we do have the allocation information at the country, sector, and industry level. And plus we do have some stock level information as well. I'll get into more detail for every one of them, and I'll show you very simple backtests on each of the data sets and how you can use it to improve returns. I won't get into detail of the timeliness or the analytics behind, but as EPFR, we are generally a data provider, but we also have an in-house quant team, which I'm a member of as well. We do have a quant team in US, and in APAC, and in Europe. And we generally use R as programming language. We have a library called EPFR on GitHub, which is publicly available. We generally deliver data via FTP, and we do have an ongoing API work. Hopefully we will be there someday. But we do also have a user interface as well, as you can see here. But in general, as quants, we prefer to use FTP data delivery. We generally use in our backtest MSCI equity indices, but we also have Bloomberg, ICE, and IMF and World Bank databases if we have to download any type of data. And through this library of EPFR, we run this ranking and backtesting algorithms in a quite simple way. This is a very simple example of code which simply generates a sector strategy, but it's all not more than 20 lines of code. You can run this, you can look at it in detail, but you can run this and you can use our data to run the same test at your side using this algorithm. Simply downloads information and ranks the flows and countries versus sectors, and then generates the statistics that I'm going to show you in a few seconds. So this is the main setting, the fund flows, generating information in the cross-section of different asset classes, countries. So I'm going to start by explaining our multi-asset proof of concept strategy. So this strategy mainly has 17 different asset classes. As you can see on the screen, 10 of them are fixed income, 7 of them are global equity regions. The idea is to test this flows to each of them in the cross section every day and rank flows, and then go long in the ones that had received inflows, go short in the ones that had received outflows or relatively lower inflows. But there's one important thing that we should take care of. So if you look at fund flow data in the cross section, it generally works well if you look at only equities. It generally works well if you look at only fixed income. But when you combine fixed income with equities, especially in the US, there is this wealth effect coming from equities, because equities has been outperforming in the last 20 years. People tend to budget in their returns and tend to get out from equities into fixed income, and that trend. That's a long-term trend line that you will see. That's a big rotation going on in the last 20 years. And if you're not aware of this, in your backtest, you might easily fall into trap of having short on equities for 20 years just because of this fact. That's why we make only the multi-asset exercise. We make a very simple adjustment within equities and fixed income indices we include, and that adjustment is the beta adjustment. So these are betas versus the MSCI World Index, and these are the raw fund flows as a percentage of total AUM into each asset class. On each week, on each day, what we basically do is to run a regression between these two and calculate an adjusted flow for each of these asset classes and use that information to generate cross-sectional analysis. This helps us to actually, you can see it on the chart on the left-hand side, this helps us to adjust for this long-term bias versus equities outflow versus inflow versus towards fixed income, and have a beta-free fund flow across markets. This is a very simple adjustment, but it generates quite significant and important results. And that's what we explain to all of our prospects, all of our clients, while using equities versus bonds. Making this type of adjustment is kind of useful. So this is a proof of concept strategy. It uses a very simple variable, flow divided by total AUM over the last 20 days, and it rolls out throughout the history, and then makes the adjustment and ranking. And if we run this multi-asset 0.51 Sharpe ratio, this isn't too high. I know there might be other, some hedge funds guys looking for 3 or more Sharpe ratios generally. But as a multi-asset PM, I could say a Sharpe ratio in a general sense, a Sharpe ratio of 0.2, 0.25 is quite a success if you're managing a big fund, and having a very simple idea generating 0.5 Sharpe ratio is a significant number. And if we focus on fixed income or global 7 equity, again the returns and Sharpe ratios are quite high. How we calculate this is quite simple. So Q1 is the portfolio of inflows of the asset classes that had inflows, and Q5 is the portfolio of asset classes that had outflows each week, and 3.8 is just the difference between 1.5 and minus 2.4. And the Sharpe ratio is calculated by just dividing the standard deviation of these weekly returns. This is a weekly rebalancing algorithm.
Just have a quick question.
Yeah,
Do you include the transaction costs?
No, we don't. This is, as I said, a very simple algorithm just to show as a proof of concept. But I can say this has a low turnover.
Yeah.
Flows are generally consistent. It doesn't generate too much returns. It doesn't generate every week, every second signals that you should trade on. This is just a very low turnover, relatively low turnover strategy. And these are the returns for longer holding periods. Quite consistent, especially until quarterly holding periods, both for multi-asset and global 7 equity regions or fixed income. This is the trading timeline that I won't get into detail, but this takes into consideration the fact that there is a T+2 lag between the flow information, arrival of the flow information, and the return information. Okay, and this is the coverage. So monthly flows, multi-asset, we cover 35 trillion And at a daily frequency, we cover around 24 trillion US dollars of assets. This specific strategy, this multi-asset strategy uses 11 trillion of this total fund flows because there are just 17 different asset classes we use. This is just one way of using it. The other way of using the data might be selecting countries and their equity indices and using the same idea. This time again we do have flows, but this time we only focus on the cross-border fund flows. So this strategy, I'll get into detail, but I'll just show you how we calculate it. I think that's much more interesting. So because we do have allocation information of cross-border funds, and because we do have fund flow information, combining these two, we can generate some fund flow coming to a specific country coming from cross-border fund. So imagine a global fund, iShares MSCI Global Equity Fund, having allocation to 5% to an EM, another 20% to a developed market. We know this at a monthly frequency. The only assumption we make is that this allocation that we know by the 23rd of each month doesn't change throughout the month. And after making this assumption, what we basically do is to multiply, as you can see here, the flows by the country allocation. For example, in this case, SPDR's MSCI ACFI UCITS ETF have an allocation to Japan of 7.7%. And when it receives a flow into of 168 million US dollars into this fund, we can say on this specific day, this will invest 12.9 million to Japan. And if we aggregate this across funds, then we will have an aggregated flow to Japan, and this will be only coming from cross-border funds. We also track the single country mandated funds, which is only Japan mandated funds. If we sum those up, that will include, that will give us a total Japanese flow. In this exercise, we only use cross-border equity fund flows. That means we only make these calculations and use the total AEM and fund flows coming from those country, those cross-border funds. So if we run this exercise, and in ACFI countries, for example, going long in countries that had received inflows, and going short in countries that had received outflows, this is just equities. ACFI countries generate 6.6% return, the Sharpe Ratio of 0.55. EM countries generate 0.43 and a return of 6.9%. We are completely honest when we are showing our results, and these are, as I said, hardly optimized. Again, 20-day flow is a percentage variable, very simple way of showing the data, and yes, we do have some negative years around, which gives you an idea of how you can do better by optimizing this strategy. Also, we do have a paper on this. I'll explain this in the end of my presentation. We do have a published paper on this strategy in Journal of Alternative Investments. So this is just a finding, and this is the longer holding period results. But what if we use this simple exercise to calculate a much more simple thing of going EM versus DM, which is a very simple question that we try to answer every day. Just using returns of flows of EM and DM, we can generate a very simple strategy going long if EM is higher than DM as flows in EM equities, and going short in DM equities, and doing being the reverse in the latter case. So this is a very simple strategy. Again, it generates a decent Sharpe ratio. But to understand, looking at those papers and to understand the effects of, for example, some events like central bank meetings, we also make some more adjusted, more detailed views. So using flow data, we can generate this type of chart. So this is a colorful chart showing 1 week fund flows post FOMC meetings over the 18-month period. This is from our, by the way, Quant Corner blog page. We publish weekly ideas and weekly quantitative calculations on fund flow data on our Quant Corner in our Informa web page. And this is the chart coming from there. So I wish I had the chart updated using today's FOMC information after the rate cut. But this is quite intuitive. Why? Because you can see the shifts in the sentiment and the narrative of the market quite clearly around here. So after the FOMC meeting in January, you can see flows into EM local currency, EM hard currency, US high yield, EM equity. After 20 March, again, almost the same, just by changing the sorting. And this isn't the same, so there's a different narrative around May, and quite similar narrative again back in June, and we see quite similar narratives in the last two FOMC meetings as well. So this is kind of shows an intuition about our quantitative calculations as well, because it shows us that the narrative of the market around FOMC meetings is kind of significant in portfolio allocations and portfolio shifts. And using this information, we can use, for example, we can make a country selection strategy just on the weeks of FOMC, and we can look at the returns of that strategy 2 weeks before, 1 week before, during that FOMC week, and after weeks. So this is the chart of it. As you can see from here, T-2 means 2 weeks before FOMC. So if we run this exercise only on the weeks 2 weeks before FOMC meetings, this just generates around 2%. 1 week before, it doesn't generate anything. 1 week after, it doesn't generate anything. 2 weeks after, it doesn't generate anything. But on the week of FOMC, it does generate quite important information. And most of the return of the EM strategy that I showed you before is actually being generated on the FOMC weeks. This is quite a significant finding, because knowing what's going to happen, which asset classes is going to be on more interest of asset managers on those specific events, on those specific weeks, is quite significant information throughout time. So one can just generate a simple strategy of using this only on the weeks of FOMC, and again, by having a very low turnover, generated strategy. So this was equities. We can also generate some FX strategies as well. As EPFR, we're constantly adding new data sets. So country allocations, sector allocations, industry allocations, stock level allocations, these are all data sets that we already have. We are currently working on FX allocations data, which takes into account the hedges, derivatives in mutual fund portfolios, and generates a net FX amount allocation. That isn't ready yet, but this one uses only the cross-border equity funds. And just bear in mind that these are mutual funds, long-only mutual funds, which generally has these cross-border equity funds, which generally has less derivative information and derivative usage in their portfolios. And because of that, when they invest into a country, it's actually an investment directly into that FX, into that currency. So using the same information that I show you. Yeah.
You mentioned that you're creating new indices
Yeah.
where you're looking at the hedges. So basically you're incorporating you basically get information whether that currency risk is being hedged or not.
Yes.
On a fund basis. Okay.
Yes. So that will be a net FX allocation, especially for fixed income funds. That will be much more useful.
But do you also give a breakdown of the hedge ratio as well?
That's a discussion that currently we are making with that's kind of a discussion that we are making with our own data engineering team, because there are costs related to doing that and not doing that. So we are trying to get that over.
Because I think that's the problem is usually for the hedge ratio, people just do this.
Yeah.
And they have no idea.
Yeah. Yeah.
So that data would actually be I think just the hedge ratio itself would actually be very useful information.
Yeah. All I can say is at this stage we do have derivative by derivative information in our hand.
Yeah.
It's just about working the data and generating a structured database out of it. So that's an ongoing work, but it should be ready around end of November and December. So quite ready at this stage. Hopefully in our next talks maybe we can talk about that as well. So, but this FX strategy uses only the country allocation information of cross-border funds and generates a very simple strategy. As you can see, this is for all country world index. This time we don't have any negative years, which we are proud of. But the Sharpe ratio is much more better. This is quite a significant Sharpe ratio for this. Again, 20-day flow as a percentage, non-optimized results, and Q1 minus Q5 is around 5.6%. For EM it's around 0.43, for G10 currencies it's around 0.52. Again, the same kind of information that we run for the analysis, and these are the longer holding periods. I won't get into these details. There are 80 slides, by the way, and we made 40 right now, so just bear in mind that we have a long way to go as well. So, any questions at this stage on any of these strategies?
I've got one, just more.
Yeah.
Sorry if you already said this.
No.
Quite a lot to take in. So when you're exploiting these flows, so you've gone through a couple of strategies here, looking on the country and looking at the sort of equity in a sector basis. Are you, just to be clear, when you calculate returns from a strategy, are you effectively shorting the bottom ones?
Yes.
You are? Okay.
Yes. Yeah.
Wasn't clear, fine.
Yeah.
So,
yeah.
Sorry, just one going on from that. So on your chart where you showed the returns at different time horizons, and you showed it very much in the current week. Is that the T? You remember the chart we had?
Yeah.
Would your interpretation be a lot of that is the market impact of these people moving into these asset classes? Because it seems to be quite short term, and because a lot of these people are quite long term holding periods. If they're investing, thinking they're going to make money in those sectors, would you expect that alpha to persist? But it seems to be in that way. Is your interpretation that's market impact versus moving the markets when they're moving into and moving against?
I think flow information, especially the shifting of the country asset allocation on those FOMC weeks, is more significant than a quiet week of no news, no portfolio allocation. If a portfolio allocation is going on, looking at flows, we can generate some extra alpha just looking at that information, because that's the same algorithm we run by using T+2 lag, weekly information, and so if you just look at the flows which occurred in the FOMC weeks, and if you trade on that information only, it will be just 8 trades every year. So that's the Sharpe ratio. If you do that before the FOMC week or after the FOMC week, it doesn't generate that significant information. But you see that flows generating that information on FOMC weeks, and those are quite significant, especially within EMs. We do have results for ACWI and other stuff as well. We see similar patterns. And this is also the findings of IMF, BIS papers as well. So portfolio allocation shifts occurring
driven by that.
Yeah.
That makes sense.
Yeah.
So I understand people managing so much money, they see the results of the committee, and then they decide to reallocate their portfolio.
Yeah.
So would you say? Sorry, I'm hogging the questions now. Most of the funds that you're covering are long only or long short, or what's the mix?
Long only.
All long only.
All long only.
So when they move, they're going to move into those new assets, and I would expect them to push the price up of those assets they move in.
Yeah.
And I'm just curious. Just what you think.
This is a very good question actually, and it also gives me to explain the detail on that, because we track fund flows. So flows into funds is one thing. And when the flows comes into that fund, what the fund manager does is another thing. That's the allocation information we have. Here we are trying to utilize the flow information of retails, institutions in total, and what is happening during that week.
25 days, or you add a few weeks or reduce a few weeks. Also, how do these strategies perform better if you just say, I have like a quintile cutoff, so I just say, I'm just going to go long two currencies at the top and short the bottom, not go in the whole market.
We've done exercises and we had better results, like fitting a function on quantiles and trying to understand the shape of it, or cutting at higher quantiles or lower quantiles. We tested those, but we tend to not to provide that type of information to our prospects, clients, because it feels like some pushing in the data and pushing and to generate some kind of signals, because we are a data provider and we are just quants to trying to show the theoretical value in the data. That's what we are trying to do. That's why we don't try to optimize our results. But yes, you're right. If we push it a little bit, we can. Those Sharpe ratios can easily go up to more than 1.
So related to the gentleman question, so when you see those excess returns related to the fund flow in the event week, what's the holding period? Is it 1 week as well? Or?
Yes, it's a one week holding period. Yeah.
Just got a quick question. Yeah. What's your explanation as to this outperformance? Do you have a kind of explanation yourself as to why you think that this is, this occurs? And is it just a proxy to the market's interpretation of the FOMC?
Yeah.
It's a useful proxy.
That might be one explanation, being as a proxy sentiment, that line of and the global allocation shifts. There's a very good paper from again BIS looking at the factor structure of the fund flows. They say there's just 2 main explanatory factors. One is equities versus bonds, which I will expect. The second one is for US investors, foreign versus US. So in those 2 explain up to 90% of the flow movements, and that decision is actually a decision every fund manager or every asset allocator makes every week on their tactical asset allocation committee. So it's not a surprise. Looking at fund flows, we can I think understand the current narrative of the market. That's one explanation. The other explanation can be some kind of price pressure, especially generated by these mutual funds, which are some of them are uninformed investors. I'll get into that in detail, especially in the stock allocation pieces. That might be another set of explanation.
So,
Per your do you have any comment?
Yeah, so I missed unfortunately the first part of the talk. We're talking about mutual fund flow.
Mutual fund flows, yes.
Specifically.
Mutual fund plus ETFs.
Plus ETFs.
Yes. In total, we track 35 trillion monthly, 23 trillion weekly and daily. And these are all long only. We don't track any hedge funds or any other segregated mandates or anything.
Do you require managers to self-report to you? How do you get? Because isn't there a problem when things
Yeah.
aren't so good they don't report anymore?
So the source is directly from the fund managers, and Steve is here and he can explain it more in detail. But generally, we directly have this information from the source, or we are piggybacked into kind of regulatory reporting. All of these fund flows information is a publicly available information. We just take it and put it into a database.
Sorry, to my knowledge, I might be wrong, but mutual funds reports on a monthly basis. So, but I understand from what you're presenting here that you get more frequent reporting.
Mutual funds, so the allocation information is actually quarterly. Fund flow information and the net asset value information is actually a daily publicly available information. Because the net asset value of the fund, the price change of the fund should be known to clients that are investing into those funds.
How do you transfer the flow into the constituents if you don't know the constituents exactly? As in, if it has been reported, say, a couple of months ago, because as you say, it's quarterly.
Yeah, so that's the important part. So the allocation part is generally reported quarterly. But because we do have long-term relationships with these asset managers, we do have access to their monthly information, monthly allocation information, and we do add an advisor, a fund manager, to our database if it is reporting, if it agrees to report us at a monthly level. If it does not, we don't add them to our database. In total, the country allocation database, the size of it for cross-border funds is 3.5 trillion. And if you add the single country mandated funds, we do have country flow information around 27 trillion of total assets. So it's a very good sample. So the allocation information, yes, you're right, but the net asset value information is already publicly available. You can calculate the difference between now, today, and tomorrow, and then subtract the now change and come out with a fund flow number. That's what we do, basically. I can explain you in detail if you like. We do have slides on that. It's a very easy calculation. So because we do have sector allocation information as well, we can generate sector strategy as well. So mainly same idea, but there are two assumptions this time. So we do have country allocation plus we do have sector allocation. So we need to combine this information to generate a country-specific sector rotation strategy. For example, for EMs, we can generate this information, or for example, in this case, for Asia. So this is again SPDR's MSCI ACFI UCITS ETF. We know that its allocation to Japan is 7.7%. Plus, we know that its energy allocation of the total fund is 6.9%. So there is two assumptions here. The first assumption is that these allocations doesn't change throughout the month. Second assumption is that for each country, these sector allocations are similar, are same. So that is a big assumption, we know. Yeah. But that is generating some significant information, so that's why we are using it. So energy allocation 6.9, Japan allocation 7.7. If we multiply that by 168 millions of inflows, then we will have a sector flow contribution of 0.9 million coming from this specific fund to Japan energy sector. If we again aggregate this, we will have a total flow going into Japanese energy sector asset class. And if we run this exercise of going long in sectors within those countries, for example, in EMs, going long in sectors that had received inflows and going short in sectors that had received outflows, results are quite significant for emerging markets, Japan and United Kingdom. For Eurozone, we have minus results. For United States, again, we have negative results, which tells us And I think this is, again, important information. Using some kind of contrarian strategy might work out of there, because those numbers, as they are negative, but doing the reverse would also work for Eurozone. That's an important finding. I don't have an intuition on this, by the way. If you're, if you have any idea, I'm happy to hear why the difference between Eurozone and Japan within sector selection. I don't have an intuition on that. Yeah, this is longer holding periods. I'll skip some of these because this starts to be the same exercise, doing the same stuff. So you can run this same exercise for EM hard currency bonds, which is simply selecting, this one is selecting CDS and going long and short using the CDS spreads of different countries, which is generating, again, positive results. That 15 basis points is out of, you can say, generally an EM CDS is around, if it's a good country, it's around 150 basis points, 200 basis points. Currently, I think Turkey is around 400 basis points, Argentina is around 700 basis points. So those are outliers generally. Mexico, South Africa, Brazil is around 200 basis points. So you can catch a movement of 15 basis points out of that 150 to 100 basis points if you run this going long, short in countries by selecting EM hard currency performance. Similar stuff for EM local currency bond strategy. I'll just skip this. But using flow data and allocation data, you can do something else, and that is the active versus passive allocation strategy, which is something, again, simple but different. So because we do not know the average allocation of towards a specific country of active managers, and also because we don't know the average allocation of passive managers, we can compare this, calculate the ratio or spread between these two, and then try to find out which are the countries systematically are being held as overweight, and which are the countries that are being held by as underweight. And if we run this exercise, again, a very simple exercise, but we do have, again, quite significant results for ACWI, for EFA, not for EM, but for ACWI we do have, for all country world index, we do have quite good strategy results. And this is because the allocations are at a monthly level. This is a monthly allocation, and monthly turnover is quite low. Yeah, and we can do the same stuff for sector selection by going long, short, by just looking at the active and passive average allocations to each sector. Yeah. So up to this moment, I explained country allocation, sector allocation, fund flow strategies. We also have a stock allocation database. At the stock level, currently we track around 9 trillion of assets invested in stocks, more than 17,000 stocks globally. This is different than 13F filings because 13F filings are generally about US institutional fund managers. They are quarterly only with a 45-day lag. Actually, it's when it is reported, these are just recorded. And it's about US equity holdings only. Whereas our database is monthly with a 26-day lag. It's a unique database. I think we do have the first mover advantage in here of having the stock level allocations of mutual funds and ETFs at a global level. The only important thing about this, we can't give our clients the fund level information. Instead, we can give some aggregated information about the funds, because this is due to our NDAs in place with our providers.
What is the 26-day lag? Where does it come from?
So this is our standard data delivery. So every 26th of month, we deliver the new stock allocation statistics. So because we can't give you fund level information here, which would be quite nice, but giving the average allocation of Wells Fargo's X fund to Apple, and it's changed throughout time. It's a very important information. We have that information, but we can't disclose it to our clients. But instead, we can do, as I said, aggregated informations, and we can generate some factors. That's what we do. This is the coverage statistics, by the way, if you like to look at more detail. And as I said, currently it's around 9 trillion in both in active, passive, ETF, and mutual funds. Because we can't give you fund level information, what we have done is to generate some factors. And these factors are, as I said, quite simple factors that we have generated on the back of the data. Generally, some of them are coming from the literature. We are constantly adding new factors into our silo, and we can always do customized calculations for our for our clients as well. But mainly, if I can simply explain, this is flow momentum, so flows into that specific stock coming from all the funds. So mainly what we have is allocation for each fund, allocation information times flow. So what we do, again, as I showed you for the country example or sector example, we can give you an aggregated number for each stock. So basically, this is aggregated number for that specific stock divided by the total AUM invested in that stock. This is flow momentum. So this is the same variable that I showed you in recent slides. These ones, especially these two buckets, are based on an idea of very simple information that if a manager is receiving an inflow, then it's a good manager, and then if they are increasing allocation into a stock, then we should also follow them. That's a very simple idea. So just look at managers receiving inflows and just generate herding of their allocations. This is one idea. This one is interesting, allocation skew. That is about, so just imagine a stock being held underweight for the general investment committee, for our, let's say there are 500 funds holding that stock, and 490 of them are generally underweight. But 10 of them has huge positions with high convictions. If we can identify them, then we can say those guys might be holding some kind of private information about that stock, and we might want to exploit that information. Okay, so this is a way of looking at that. And also we do have, these are again coming from the literature. This one is a breadth of ownership and stock returns from GFE. The fund count, number of funds investing, seems to be a good factor. So number of funds investing into a single stock is a good indicator. And Herfindahl ownership concentration index is the ownership concentration of stock flows, stock allocation. So if a stock is being held mostly by just 3 or 4 funds, then it becomes a risk for that specific stock, because when those funds receive an outflow, that's an uninformed and a non-fundamental risk in generating a price pressure on that stock. So that is there to exploit that effect. Okay? These are all again coming from the literature. And yeah, if we run this exercise of using each variable and using different universes, S&P 500, Russell 1000, MSCI EM, so, and different look-back periods. If we run these exercises using these variables that I just defined, some of them are daily variables, some of them are monthly variables because they are just reliant on allocation information. The results are this. So, and what we basically do is to generate a flow alpha model by weighting by these weights, And as you can see, the fund count, number of funds investing, has the most weight in this flow alpha model. Then it generates quite a significant result, and I'll just show you the Sharpe ratios as well. So, for example, for MSCI EM, we have almost 1.0 Sharpe ratio. For S&P 500, we have 0.76. So this is again a simple exercise of using those variables and going long and short due to their numbers every week or every month. So this is actually all about our stock allocation database. Do you have any questions on stock allocation database? I'll just pass into some other use cases of stock flows and flows information, and then conclude. So, any questions, ideas on stock allocation database? No? Perfect. So, I'll just conclude by giving you some ideas and some papers to read and look at. So, this is from one of our webinars that we have done this year. So using stock flows, one idea is to detect crowding, and that is quite an expected use case of the data. So this is quarterly flows into top minus bottom momentum quanta. So as you can expect, what we do is to run a very vanilla momentum strategy first, and then select some stocks and look at the flows into those stocks each day. Okay, and then we have this chart of saying, for example, in Russell 2000, that momentum strategy in total here is somehow kind of overcrowded. At this stage, it's much less interesting for investors. So this is one way of generating, you can do this for momentum, low volatility, whatever you like, and look at the flows. Yeah.
This would be kind of equivalent, right? Like some of those factors you've computed are sort of Z-scores, right? Because you've got the allocation minus the mean allocation.
Yeah.
If you say that like a Z-score beyond these tails is
that's another way of using data.
Sort of analogous, right?
Yeah, correct. So so detecting stock crowding is one thing that you can do, and looking at the impact of passive funds. So passive funds is it's quite well known that today is we have a very much higher interest towards passive funds, and that is having an effect, especially on stock selection and stock allocation, because those ETFs, those passive funds, are generally uninformed investors again, and they're just following the market cap weights, and they're generating some kind of effects on the market. So what we do is to generate these. Breadth is the number of funds. It has a fancy name. We as quants love to do this, but yeah, it's number of funds investing into that stock. Dispersion is the dispersion between allocations of fund managers. And if we run these different, so fragility, this is actually a quite good way of looking at the data. It's coming from a JFE paper from Greenwood and Tasmar. I'll show you the citation of it in a few seconds. But it's simply calculating, so if there are 10 funds investing or 1,000 funds investing, but if their flows are correlated of those 1,000 funds, then they might act like the single fund, and that's an important thing. So that might generate an effect again on the stock flows and stock volatility. So this is quite a significant result that we find. If you look at the cross-sectional volatility, especially the breadth number of funds and the fragility, and these Herfindahl, I'll again explain these in detail. I can explain these in detail if you like. But these two are again measures of ownership concentration. If we look at these, we find, especially in volatility, skewness, or kurtosis, quite big differences. And if you look at the kurtosis, so the tails, the Herfindahl and breadth is quite significantly important in understanding and knowing about those behavior of stocks, looking at flows. So this is another way of exploring and looking at the data. This is another way of looking at fund flow information, of calculating rolling betas for different asset classes, and then looking at the current beta of that specific asset class. So return versus fund flow betas, and then looking at the current susceptibility of that specific asset class to fund flows. This is, again, this might be another weekly information that you might want to look at. This is the results of passive funds on these specific asset classes. And if you look at, for example, UK, you will see that this is historically, this has been close to historical lows in terms of flows versus allocation, because there are much other things going on at the moment. But if you look at, for example, the local currency, this might look small to you, but in terms of historical movement, this is very close to its historical highs, which is another important. So they are much more being affected from flows compared to their historical average.
Sorry, the beta here is relative, so it's return versus the fund flow.
Yes, exactly. Return versus fund flow and their historical betas throughout time. Those box plots are showing the ranges historically, 1 year betas. So these are just to provoke some ideas inside your head. Feel free to ask any questions. So yeah, and there are other use cases that I see in the market our clients use. So looking at, for example, intraday patterns of RFQ data, both in equity and fixed income markets. This is quite expected, by the way. So fund flows are occurring other day. These are for especially for brokers. These are being RFQs for these guys. And because we do have some premium daily information at T+1 as well, so all of the presentations has been made by T+2 assumption, but we do have a T+1 because markets are closing from east to west, and we start gathering that information. So by 9 a.m. in the morning, actually we do have information on around 50 to 55% of the total AUM we track. So, and then we can publish that information. So if you look at that, there are certain relations between, yeah.
Sorry, RFQ is request for quote.
Yes, yes.
Where do you get that from?
So these are the use cases of our clients. We don't have that data. This is just the use case of some of our clients or some of our trials, as I can say. That is a very hard information to get with RFQ. Bloomberg has some data, but I have never managed to get all of it.
Yeah, I'm not sure. I think maybe for regulatory reasons.
Yeah.
Like I guess regulators would have some of this.
Yeah.
I don't know where you.
Yeah. Some brokers have their internal
Yeah,
databases.
brokers would have their own internal.
Yeah, and I had a chance to look at some of them. That's all I can say. The second one is actually publicly available information, looking at patterns of ETFs on intraday volatility. ETF flows, passive flows, affecting the intraday volatility, and looking at time buckets. That's another use case. For example, between 9 and 10, there's an inflow into, let's say, an ETF, and they're coming to the market between 9 and 10, and between 2 and 3, we are again seeing another increase in the volume. This is again another use case of flow data, and its effect at T+1, T+2 intraday information. This is quite, mechanical information actually that you would expect when executing your trades.
And where is this coming from? The intraday ETF flow information?
So the flows is not intraday. It's only the daily end of day flow, but its effect on T+1 intraday volatility that is quite significant. That's what has been found out. So ownership dispersion, fragility of liquidity, that's what I tried to explain before in earlier slides. And some other thing that can be done, which hasn't been done yet, but I find it quite promising, is to use this stock allocation information to position, to know about the positioning before quarterly announcements. So generally quarterly announcements, generally 13F filings are quarterly, and before this time you don't have a chance to look at these stock allocations between active fund managers before revenue announcements. But using this monthly information, we have at least an edge to know more about monthly movements of fund managers. So before the quarterly announcement, we might have a chance to look at if we know there's going to be a surprise on that, let's say, revenue announcement, and if we know, if we look at the cross section of the allocation and positioning, that might generate an extra information. So knowing the surprise is an information, but that's not our business. But knowing the surprise and knowing the allocation information, knowing the positioning, that might generate an extra information. So that's something that I think we will be looking in the close future. And these are some papers. The first one is from our team, Fund Flows as Country Allocator, Journal of Alternative Investments. And these are the other ones that might be good reads. Generally they use 13F filings. There has been no academic paper yet using our stock allocation data because it's relatively new. It was just out in 2017, is that right, Steve? Yeah. So, but yeah, there are some academics right now working on this. So these are 13F filing data which can fully be replicated at a global level, which is a quite interesting thing to do, I guess. So thank you for coming and listening. I think if you have any questions, I can happily answer. Or that's it. Thank you.
Has anyone got any questions, or were they answered through? I guess we could ask a lot of questions through the talk as well. But any further questions? I've just got one question. If anyone else hasn't got one. Do you tend to find that it's constant, like looking at your data, or is it more discretionary fund managers, or is it a mixture of the two? Who likes it?
It has historically been more discretionary and sell side, but in the last, I guess, 2 or 3 years, there has been a huge increase in interest from quants, and right now we have so many quant clients using the data.
Well, thanks again.
Thank you.
And it's very, very interesting talk, because especially all the different use cases, the different asset classes.
Thank you. Thank you.
I'm sure everyone from the questions was interested too. But hopefully you can come to the next talk on 20th of November. So that's my birthday as well. So another reason to celebrate. So thanks again.
Thanks.
Please, if you want to fill in the survey for the machine learning course, then please take the time to do that. Thanks again. Thank you.